Okay, good mornings and good evening for those from Asia. Today's welcome again for to our Aurora virtual seminar. Today we are very pleased to have Christopher Palmer to be with us to share with us his paper on the last mile of monetary policy inattention, reminders, and the refinancing channel. This is a paper co-authored with I'm not sure whether it's co-authored already in the session. Okay, Chris, all to you.
Great. Thank you for the introduction, Tianfu. So it's with Shane Byrne and Kenneth Devine, Michael King, and Yvonne McCarthy. And it's been a fun setting and a fun project. I'm excited to tell you about it and the spin that we have on it. And it relates well to some other work that's been presented recently in the Arroya seminar. So let me jump into it. So our angle is thinking about the refinancing channel of monetary policy. We have a bunch of evidence now that this is a really important channel. If you were like listing all the different ways that monetary policy passes through to the real economy, that through the household sector, refinancing fixed rate mortgage debt is a key channel. And interestingly enough, as is fairly transparent once you think about it, you get immediate monetary pass through if you have floating rate debt that is tied to an index. But for fixed rate mortgages, you need to refinance. So we have good evidence now that unconventional monetary policy, conventional monetary policy, this is an important channel, that people are more likely to avail themselves of refinancing opportunities after rates have changed. And once they do that, they're more likely to have higher consumption. So we see this channel, it seems important. What that means, and this is highlighted in a handbook chapter by Ammerman and all, is that any refinancing friction is going to inhibit the transmission of monetary policy. So just kind of looking at some of the top ones, there's a double jeopardy that Anthony and John have highlighted, that often when you want to refinance in a crisis, it's exactly when you're more likely to be unemployed or to have low credit scores or to not have the property value equity that you need to be able to refinance. Baraha et al. Make this point at all on the need for having sufficient equity to refinance your mortgage, which might be particularly problematic exactly in a crisis, exactly when monetary policy is trying to be really accommodative. And you need to be in a segment that has credit market access. And if credit markets have dried up and there's one particular segment, there's strong segmentation and one particular segment has access and you're not in it, well, then too bad. You're not going to have as strong a monetary policy transmission. You're not going to face as strong a stimulus. So that's where we come in, is we're trying to think about this setting and think about whether we could address a refinancing friction and thereby strengthen the refinancing channel and improve what we're calling the last mile delivery of monetary policy to the household sector. So let me explain what I mean by this term, last mile delivery. So if you think about logistics, what logistics can do is they can pretty cheaply move things within their supply chain from suppliers to factories, do the manufacturing and put it into logistics and ship it and get it to the warehouse. The most expensive part of that chain is the last mile that Amazon Prime brings it to my house. And so that's the problem with e-commerce, where we're starting to see a lot of appreciation in the industrial sector over the last decade or so, is this kind of logistics and needing to stage things right before last mile delivery. So that's our analogy for monetary policy. It's fairly straightforward for monetary policy to create financial slack, but for it to get all the way to the real sector, you need other things to be on board. So chief among those is going to be, you need take up by demand. And so any frictions that inhibit demand from knowing about opportunities to take advantage of monetary stimulus, or qualifying for it, like I mentioned, or being aware of it, paying attention to it, are going to be important last mile problems. But just to give you a flavor of how I think this is much more broad than just household sector and just refinancing. There's an interesting paper by Gormson and Huber that has tracked conference calls on what firms state their cost of capital is and what their hurdle rate is for investment. And they're okay at understanding that when the policy rate changes and when the risk-free rate changes, that should affect their cost of capital. But that doesn't end up playing into changing their investment hurdle rates. And so you see their investment being less responsive to monetary policy than it would be if there was this like one-to-one pass-through from risk-free rate to their hurdle rate. So that's another example of this last mile problem of monetary policy. We think attention is a very likely culprit for the last mile problem because of evidence that we have across a wide variety of domains, including mortgages, that people are fairly inert, that they don't make active choice. And so we've largely tried to deal with this by doing something different with the choice architecture, like default options for retirement savings. But we're going to show that we can target inattention and actually partially address it. So we're going to look at that as a key friction using a treatment. We know that inattention is a problem, and lots of papers, lots of things that show that. We're going to show something that seems like it worked in improving inattention, in increasing attention, and we'll be able to estimate these attentions, these treatment effects on attention, and we see that as a new potential policy tool that people could use. Let me highlight the problem this way. I'd never seen a graph quite like this, but it's probably fairly intuitive to a lot of people on this call. So in green is the federal funds rate, the policy rate in the United States. In red is the average interest rate on new mortgages. And so you see they're very highly correlated. There's a pretty tight pass-through from the policy rate to new mortgage interest rates. Now, of course, if you're looking at the stock of existing mortgages, which dwarfs in magnitude the size of the flow, existing mortgage interest rates are changing quite slowly and in low frequency relative to policy rates. Now, does this matter? Well, if you were a policy maker and you were hoping to stimulate consumption in aggregate, you might not just be thinking about the people who are taking on new mortgages right now. You'd somehow like to affect the stock of mortgages and thereby aggregate consumption from the household sector. Now, if everyone was on a tracker mortgage, then this would be straightforward, but a lot of people are on fixed rate mortgages or adjustable rate mortgages in the US that have a long fixed rate period. And so they would need to refinance to take advantage of this. So the blue line is going to move slowly only as the flow updates. And because there's not tons of refinancing at any given time, it's going to adapt quite slowly. And you're not going to get a lot of oomph from either accommodative or restrictive monetary policy. I'll show you the same thing for Ireland in a little bit. So our question is, could direct communication improve inattention to refinancing? And there's plenty of reasons to be skeptical about this. If you're thinking about direct communication as a monetary policy tool, and you set aside central banks' sometimes reluctance to kind of tell people how they act. If you look at communication as it exists right now, well, most people don't know what the FOMC is. If they did know what the FOMC is, they wouldn't be aware of when the announcements are. And if they read the announcements, they are at a pretty technical level. So it's unlikely that households are going to necessarily pay attention to communication. We have evidence in other domains that when you give people disclosures and you try to make it really interesting and really clear, that people don't open the letter in the first place. And so that can be a problem, or they open the letter, but they don't really read it and digest it. And one of the frictions seems to be that even if you show someone a disclosure or a communication that's been optimized and designed to be intuitive, they still kind of overestimate the time it takes to reoptimize. And so here I think the right analogy is the Geico ad campaign. Their entire ad campaign is a gimmick to get your attention, and then trying to push back against these pessimistic beliefs that it will take you forever to reoptimize your car insurance. That's it. That's all they're trying to do. Get your attention and then overcome your pessimistic beliefs. And so that's kind of evidence that this is a key friction that's out there. There's some reason to be hopeful. So central banks are starting to have communication campaigns. Alan Blinder's conclusion here is that there's some promise in these, but many challenges in a lot of these social media things. The Central Bank of Japan has, not of Japan, I saw Jiro, of Jamaica has reggae museos to explain inflation to the populace. So there's some attempt to give communication in a way that will be intuitive and attentive. Other reasons that we might be optimistic are that we know that forward guidance in certain settings can be powerful. We know from Gonzalo and Jordan that there's peer effects in refinancing. So if you can deliver information the right way, perhaps from a coworker that's on the same shift as you and they refinance, that you're more likely to refinance. So that suggests that there is some sort of information transmission that could make sense. There's work that disclosures can be optimized. There's very mixed literature on this. But Wang and Burke and the paper that Gaston presented in the Arroyo seminar looking at mortgage refinancing in Chile suggests that there are treatments that have been successful. It's just hard to nail those down. I think we have a good example of that and have a good reason about why our treatment seems to work. There's evidence that part of the problem is that people just aren't quite sure of the connection between rates and their take-home pay and what this could mean for their kind of monthly disposable income. And when people have better financial literacy, that's useful. On the other hand, we know development literature on financial literacy that even though financial literacy is a strong correlate of outcomes, it's very hard to improve with financial education. And then the last thing that I want to point out, because it's going to be very relevant for us, is that there's some settings in which reminders have been very powerful. And in particular, simple, straightforward reminders where the choice architecture is very simple. And so I'm going to show you an example of that as well. Reminders are not a silver bullet in every setting, but in some settings, they've been shown to be quite powerful. So if you could somehow optimize your conclusion, this could be your communication. This could be a powerful tool, especially if you're at the zero lower bound and you feel like you have limited flexibility on rates, or if you're a monetary union such as Ireland in the EU or Tennessee in the United States, and you wish that the Fed or the ECB would do something differently, but you're kind of stuck. And this is a way to take some of your sovereignty back and to be able to deliver some stimulus that's customized. So that's what we're going to do. We have a randomized control trial. We partnered with a bank in Ireland to do this. We have optimized disclosures, and we're going to send out reminders. We're going to look at the effect on mortgage refinancing. And then at the end, we're going to calibrate this into a model of inattention. We're going to estimate treatment effects on inattention in a mixture model that allows for people to be inert when they're making decisions. And then we're going to be able to use that to benchmark, to kind of do a horse race between, look, given the current conditions of inattention, how effective would a reminder be under our estimates versus lowering interest rates, for example. And we'll be able to do some interesting comparisons there to kind of contrast the effect of traditional policy and
Chris,
yeah.
Just a quick clarification. These communications effects, right? Communications from the bank to the borrower.
Yes.
And what's the motivation for the bank to communicate this to the borrowers if, I mean, the borrower has not actually optimized a refinancing decision?
Yeah, David and I were talking about this
Right.
at the top, the kind of waves that people
Right.
in industry decide that they'd like to participate in this. So
Right.
in the Irish context, there's actually a regulation that they have to communicate refinancing opportunities to their borrowers once a year. And I'll tell you a little bit more about why when I get into the structure of the Irish context. So they already have to send out these letters, and then the regulators' concern and the reason they asked the bank if the bank was thinking about would consider doing something different is that there was concern that these disclosures are just ineffective because of their design, and so that's something that the design could be mandated to be different. And I think the bank kind of a couple things were playing around in their desire to participate. One, they wanted to be a participant in crafting what policy was going to look like. Two, they wanted to learn the lessons that they were going to learn from the kind of A/B testing that you do with an RCT. And then three, they were very interested in the PR effects of being able to say that they're consumer focused and they're looking out for their customers and their borrowers.
Right. I think there's a sign. You raise a hand. You would like to?
Yeah, quick question. Hey, Chris. Just was wondering what your thoughts were on contract design around this issue, right? So in particular, sort of automatically refinancing mortgages and sort of other design features you can build into the contract to overcome this friction.
Yeah. So you have work on this, and lots of people have proposed interesting contract modifications that I think definitely solve this problem. As you know, it's been hard to scale those. There's a bunch of momentum in this direction, but it certainly hasn't become the dominant mortgage contract in any market that I'm aware of. So I think these are complementary policies. This is very short run. You're going to see this reminder letter that has surprisingly large effects, at least in partial equilibrium. And you're going to see that it's fairly simple and it kind of goes out right away and it works on top of the existing contract structure. But certainly there are pros and cons to the existing contract structure, and a very clear way to isolate exactly the problem that I'm talking about is to change the contract structure in ways similar to how you've explored. Okay, let me tell you about the Irish mortgage market and the experiment that we ran. Then I'll show you some kind of simple experimental treatment effects. And then I'll move on to the inattention model and talk about some of these, maybe not counterfactuals, but contrast and benchmarking exercises. Okay, so we're not the first to show that there's a failure to refinance. This has been documented in many different mortgage markets around the world. We've got a rich literature on this at this point. So that's nothing new. External and internal refinancing in Ireland are infrequent. And that's not to say that there aren't substantial opportunities for households to gain a lot and reduce their debt service burden by refinancing. So there's in general a low pass-through of ECB policy rate to variable rate mortgages in Ireland. I'm going to show you that. And so all told, that means that ECB rate's been at the zero lower bound in the period that we're looking for a long time. Irish variable rates haven't gone down by too much, but there are enough refinancing opportunities that 60% of borrowers in Ireland could save €1,000 a year by refinancing. And so you can then put in beliefs about like how long this persists and whether they have to keep doing this and whether they don't get the savings. But even just in the first year where they would be able to lock in a rate, they'd be able to save €1,000. So let me tell you a little bit about the structure of these mortgages. There's three flavors of mortgages in Ireland. So variable rate mortgages are, despite what you might think by the name, they can vary, but they vary at the discretion of the lender. So they're not actually pegged to a particular policy rate. There's limited pass-through from policy rates to variable rates. So banks are not often, it's a very concentrated banking sector, so they're not often kind of forced by competition to pass through those rates. But when you're on a variable rate mortgage, you can do an internal refinance without increasing your term. You could swap to another mortgage product with basically no fee, basically very small, very easy process. Okay, so I'll tell you more about the variable rate mortgages in a second. Their structure is the motivation for the regulation that we're exploiting to be able to do our study. They have traditional fixed rate mortgages, traditional in the UK sense, not in the US sense, that are fixed for a short fixation period of 1 to 5 years. And then they convert to a variable rate after they roll out of the fixation period. During the fixation period, there's a prepayment penalty. But then once you're in a variable rate mortgage, there's no prepayment penalty. There were tracker mortgages in Ireland. There are still some that exist. The problem was that their spread to the ECB policy rate was 100 basis points. So when the ECB policy rate went to zero in the crisis, these were extraordinarily cheap mortgages and they stopped being offered in 2008. And with some controversy, a lot of people have eventually rolled off and refinanced off of their tracker mortgages. So they're kind of not much of an issue. So the population we're looking at is going to be variable rate mortgages that have an opportunity to refinance, especially to a fixed rate mortgage. And I'll show you what this looks like. Okay, so in blue, again, I have the policy rate. This time, instead of the Fed, it's the ECB policy rate. And you can see how that's changing. It has somewhat of a pass-through to new mortgages. So that's new fixed rate mortgages. That's the red line. You see that the longer the policy rate stayed, I don't have liftoff in here, right? But the longer the policy rate stayed at zero, this did kind of bully the new origination rate down. But you can see that the outstanding variable rate mortgages, there's just not a lot of pass through. There kind of was at the beginning, but they're not really changing as the policy rate kind of went from say 80 bips down to zero. The variable rate mortgages stayed quite similar. So the people at baseline in our sample have an average interest rate of 4.2%. They're all on variable rate mortgages to be eligible for the policy that already is existing. And they could refinance to an option that the bank is offering them, an internal refinance that would be something like 2.9%. So that gap times their mortgage rate gives you something like times their mortgage balance gives you this like $1,000 in the first year of interest savings. So similar to the US, limited pass-through to outstanding mortgages. We think a lot of this is the last mile problem, and this is indicative of it. We think that attention is going to be a key culprit because they have opportunities to refinance and they're getting disclosures that are telling them that they have this opportunity to refinance. Okay, so what they've done in Ireland to say, wow, we have a product that is completely at discretion of the bank. We would like competition to kind of discipline that variable rate product. There's not a lot of competition in the Irish mortgage market. Maybe we should fix this with a disclosure and make sure that it's not lack of information that's causing this. And so this is the Consumer Protection Code, and it says that at least annually, every lender that's holding a variable rate mortgage needs to send the borrowers a letter that includes a summary of the bank's other products that could save them money, how they would do that, a statement that they can review options, including external mortgages. The CCPC is their Consumer Protection Commission. So a link to that so they can see some kind of non-biased CFPB-like primer on how to refinance and what this looks like, and a reminder that they can change the rates and how they would qualify for it, and then they can switch to another provider. So it has to have these elements in it. And so that already goes out once a year to all of a bank's variable rate borrowers. And so we kind of inherited this experiment that this bank was running to test this and to understand this. And so the way it works is you have the control group, that's something like 1/7 of the sample, and they're going to get the standard disclosure that they're already getting. And then there's going to be several treatment groups that are going to have variations on this letter. So I'll show you an example of this on the next slide. But part of this is going to be to simplify the letter, to personalize it, to put it in color, to have a headline. Personalized is to say maybe it's more useful, instead of telling people what their interest rate would be, to just hammer that home to say your monthly payment could be this much less, or your annual interest expense could be this much less. Thinking about kind of Kahneman and Tversky and loss aversion, we experimented with a gain frame and a loss frame, and then finally motivated by some work that I'd done in the UK, where we found that telling people about the process was quite powerful, or modestly powerful. We had a treatment group that did this. I guess my overall takeaway from some of these variants, this is I'll tell you, I'll expose what my prior was going into the experiment, was that a lot of these things look really good in the lab. So if you just put someone and you say, could you do me a favor and look at this letter and tell me which of these versions you like and which you're more likely to act on, they'll react quite strongly to different features. They might say, oh, I was really scared of the loss frame and it really made me want to do something, or the gain frame was really motivational, or the way you personalized it was so helpful, or the color one, oof, that was really aesthetically pleasing. But then in the field, disclosures have a really hard time because they're competing with real world attention frictions. So I'm getting a letter and I'm not just sitting in a room with like notifications on my phone silenced and my dog isn't here and my baby doesn't need to eat and I'm not exhausted from work. It's easy in an office like this to pay attention to those things. It might be harder at home. Okay, so then relative to other disclosure experiments, I think one of the most novel features of this, and one of the things that's going to be the most important when you see the results, is that half of each treatment group was divided, was assigned to receive randomly to receive a reminder letter 4 to 6 weeks later. And then we're going to track refinancing outcomes using 2 follow-up snapshots, and we're going to see how this all went down. Now, our letters being mailed in February 2020, this wasn't an ideal time to be running an experiment ex post. It is what it is. This led us to need to axe the survey that was also going to follow up with the bank customers to ask a bunch of things, but I think we're still able to get some interesting mechanisms even without the survey results. And then I think, as an entire generation of papers is doing, I'll show you the results, and then I'll talk through and show you some evidence, if we have time, on what interference COVID might have had in this particular experiment. Okay, so on the left is the control group letter, black and white, not personalized except for the name. It's going to tell you what your, based on your loan to value ratio and based on the fixation rate, what you could get if you refinanced. During this time period, there's no LTV pricing for these pricing. So these 3 columns are somewhat irrelevant. This is the existing status quo control group letter. I'm told that if you could see the disclosure letters at the other major banks in Ireland, this is actually pretty good. It's actually pretty clear. There's a second page of fine print that I'm not showing you. But on the right is the treatment group letter, and this is from one of the control ones that highlights the amount that you can gain. Okay, so this is showing you that, look, based on your current monthly interest rate, your current annual interest rate, this is what your repayment is per month. This is what you could do if you refinanced. That works out to be 130 euros a month in savings. That would be 1,600 euros a year. And then now the table's been augmented to say what this would be in an annual difference and what this would be for you given your balance. So that's one of the treatment group letters. That, like I said, there's 6 variants of the treatment group letters, and then half of the treatment group borrowers are going to receive this follow-up reminder letter. And so the reminder letter is very simple. There's no fixed, there's no fine print. It just says, we recently wrote you about the availability of mortgage rate options. This is a reminder. If you want to take advantage of one of these options, then here's how you would do it. Visit us online, go to a branch, call us. So that was the reminder letter, very short, very simple, and unexpected is a potentially interesting channel here. I'll tell you a little bit. Oh, Chris, jump in.
Yeah, just a really quick question, Chris. Those payment savings that's on the treatment letters, are those inclusive of any fees, like appraisal fees or closing costs that includes them?
Yeah, great question. So this is an important point to make relative to a lot of the failure to refinance literature. One thing we have going for us in Ireland is they have this essentially no cost internal refinancing option. So what we're telling them here in this disclosure is if they did an internal refinance, the only cost that they would have to pay is if they wanted an appraisal to qualify for a lower LTV bucket than they had at origination. But you can see from how the pricing was at this moment in time that there wouldn't have been any advantage to that. So really there's no closing costs, and this is inclusive of all of that.
Great, thanks.
Yeah. Michael and then Jim.
Hey, Chris, great paper. This is exactly what I do. I love this. I will ask, with the absolute bombardment of spam and scams and junk mail and all this kind of stuff. In fact, while I was waiting in queue, I just got a spam call, which I'm sorry if you heard that. But anyway, my question is, in Ireland, is it a little bit different? I mean, I visited there, but I've not lived there. Is it different? And do you think this might take away from the effectiveness of these letters, which I think are fantastic?
Great question. I'll give you 2 interesting attributes of Ireland. One is that they don't get nearly the junk mail that we get in the US. So, as you were alluding to, we get spam phone calls and we get a lot of junk mail every single day, including pitches for mortgage refinancing, right? And for opportunities there. So that might help them to pay more attention. On the other hand, trust is not necessarily great for banks, especially after salient failures in the United States. It's much worse in Ireland, I would say. So they had a lot of scandals during the great financial crisis, a lot of bitterness about the bailouts that happened, stories of old Irish men showing up and throwing rotten eggs at the CEO during a shareholders meeting. So there's this element of, on the one hand, they're not getting bombarded to the extent that we are, but there's an element of distrust that's certainly playing a role here. And I think that it's possible that the internal refinancing option is useful for this because they aren't trying to sign over their money to somebody else, and they're not totally sure what that person would be like and what's going to happen if there's something that they're not aware of. But at the same time, I would just think that if you slowly were to be able to improve trust in the disclosure, or if the disclosure that's sending the communication could be the Consumer Protection Commission or the Central Bank of Ireland, then that might help even strengthen these results. So we already find strong results as the spoiler, and that's operating on the existing platform of distrust in the banking sector. So I think there could be some opportunities. There's certainly papers about this in the US to play on this dimension.
Okay, great. Thanks a lot. I appreciate it.
Yeah, thanks. Jim.
Yeah. Jim, you would like to ask a question?
I actually had the same question as Michael, so thank you.
Okay, great.
Yeah.
Good.
Just a quick clarification.
Yeah.
On your treatment group, how do you actually select this? Randomize it? Because I think this treatment group are all those people with the current monthly repayment based on the interest which is higher than the potential repayment. I mean the fees.
Yeah, good question.
Right.
This is everybody this is a random sample of everybody. That's actually a great here's the context where I'll talk about this. Okay, so here's the there's kind of two questions that we could talk about in there. One is the internal validity, like was this randomized within, and then the external validity of like how is this experimental sample selected from the overall population of borrowers. And the short answer is that it was not selected based on gains. So it wasn't like we were specifically going after the people that had the highest gain. And so I'll show you that on this chart here. So no surprise, the randomization was done correctly. And so if you look at the control group and people who were treated without the reminder and with the reminder, they weren't getting this, but they weren't getting meaningful differences here. Let me just tell you about them. So 20% of them are living in Dublin. The rest are living obviously outside of the country. Average age is something like 50. 40% of them are still on their first home. So they haven't moved. This is the first house that they've lived in. Mortgage balance on average, this is going to become relevant when I tell you about some of the naive fixed cost estimates, is $80,000. They're facing an interest rate on average of 4.2%. They have around 13 years left in their mortgage, and they could save on average $1,000. And around 9% of them are on COVID forbearance plans, similar to the plans that we had here in the United States. So I'll use that flag later. So if you compare this to the entire population of variable rate mortgages in Ireland, you actually get a similar amount of potential savings. Now they have lower interest rate savings. They're ending up with the same amount of higher of annual savings because they have higher balances on average, but broadly representative of the population of variable rate mortgages in Ireland.
Thanks.
Okay, let me tell you about some treatment effects and jump right into it. So here's a bar graph. It's showing you the internal refinancing rate. So people that switched to a different mortgage within our provider. The control group was around 8.9% over the 4 months that we were tracking this. So around 9% of people are going to take advantage of this refinancing opportunity. You can think that's not so bad. It's just contrasting with the fact that there's no monetary cost for this. It's a relatively simple procedure since it's an internal refinancing. They're already kind of qualified for it, and they could stand on average to give 1,000 euros. And so, there's something going on here, right? Inattention, extremely high opportunity cost of time, maybe irrationally so, pessimistic beliefs about how long it would take them to switch. So that's kind of what we're operating on. Then the rest of the bars are the various treatment arms and their refinancing rates. These are people in treatment arms that did not receive the reminder. So, if you pool all of these together and you kind of like look across, I'm going to show you that there is a statistically significant effect, but it's economically quite small. And we get, interest, like some of these are going to pop up as significant. V4 is going to be, I can reject that it's the treatment effect. That's what this confidence interval for is 0 at the 95 confidence interval confidence level, but not like a super intuitive pattern. And the p-value for the equality of all 6 of these treatment effects is something like 0.6. So I just can't reject that all the treatments had the same effect. So that's the treatment without a reminder. And maybe this is quite consistent with the intuition that, like, look, you can optimize disclosures and get really good feedback in the lab, but in the field, it's going to be really hard to get people's attention. Okay, with reminders, the y-axis scale is the same here. So with reminders, you get a big jump. Interestingly, there's not so much of a pattern that the treatment arms that had the strongest treatment effect have the strongest reminder effect. And now, you can pool this, or you can pull out the best performing one. They're all statistically significant relative to the control group, and fairly powerful in the world of mortgage refinancing experiments where we have a hard time finding anything in the literature. So let me kind of show you what this looked like if I pool it all together. The kind of bundled treatment where half of people are getting a reminder, half aren't, has a 3.6 percentage point effect on a base of 8.9 percentage point percent switching. But when you break this out, you see that most of this is coming from the reminder effect, and there's a small effect of the disclosures. The reminders look like they're twice as powerful as the treatments on their own. So let me kind of just sum up in the interest of time, and then tell you about some results that I won't show you unless they come up, and then I'll move on to the model. So first thing to think about is this just COVID? So you could think that COVID could make this less or more likely to be effective. But for the purposes of kind of being conservative, let's think about the reasons why COVID can make this much more effective, which would be an external validity concern and would make it so that if somebody read the paper and was excited about implementing it in Ireland in the future or in another country now or in the future, they might not find anything. If during COVID, people have much more of a capacity to pay attention because they're stuck at home. So they're reading all their mail because they've read all the other books that are in their house and they've watched everything there is to watch online. So maybe they have more attention and maybe they're acutely feeling the need for savings. And so they're thinking about re-optimizing their financing anytime they can. So we would have liked to have not done this during COVID and to have, but we did. And so
Chris has a
first
question.
thing to point out is, yeah, Tianfu.
Chris has a question, right?
Yeah, jump in.
Hey, Chris, you would like to unmute yourself and ask a question?
Yeah, sorry about that. I thought I was happy for you to keep going and gotta wait for a break, Chris.
Totally fine.
But the one thing that I'm not seeing in a sense is, do you wish they had just sent out a short, you can benefit from a refinance, call us? So basically do the reminder in round one.
Yeah, I do. It would have been really nice to see that. And I think that it would have helped to see if, in other words, if you think about that reminder letter, it's also much simpler. It's also much easier to digest. And so it would have been nice to see just the effectiveness of that without any enhanced treatment effect. Given how large the effects are, I feel like most of it's coming not because it's got this strong complementarity with the existing letter. The thing that I'll point out is that the regulation requires them to at least send out the control group letter. So it would have been really interesting for me to have the control group letter with the reminder letter instead of the enhanced treatment. But my prior is that, especially given other work, is that probably most of the oomph is coming here on the reminder. And even if you did the regular treatment letter, regular disclosure letter, you would have still had a lot of oomph. But I would have loved for someone to have been able to do that. And I would love for someone to do that in the future.
Yeah, no, I think that point is basically that it's not really that it's a reminder, it's that it was so short and simple. There was no way of missing, and it call us. So you don't know what it is you're calling about. You may not know.
Maybe you're intrigued. It's a mystery.
So actually providing less information may also cue consumers, because I doubt any of them were going to go back from the reminder to the original note to kind of see what it is. It was probably gone in the trash. So it does suggest sort of the question of what it was, less information is more. The other thing just earlier in the presentation, it'd be very interesting to do a comparison of the US versus Ireland with the macro charts, because we know in the US, average mortgage rates fell very substantially. Essentially, the industry was capacity constrained. And the idea that you have to go to your existing bank in Ireland relative to the US, where there aren't prepayment costs of going elsewhere, essentially, those of us, or those who own homes, I actually have a Columbia apartment. For those who own homes, you presumably have gotten 5 million of these in the mail from all sorts of lenders. And so it'd be very interesting to contrast what you have with the US and kind of think about the differences in the incentives, which you started with, and just sort of see how close does the US get to, what are the elasticities, there versus elsewhere. So anyway, very interesting stuff so far. Thanks.
Okay. Yeah. Thanks. Couple interesting follow-ups. So this was, I led out with this that just shows, makes one macro point about the United States, which is that even in the United States where we do get bombarded with refinancing offers, and you can kind of hear the radio ads when interest rates fall to like a 4-year low that are pushing everyone to refinance. And presumably that marketing effort is helping stimulate attention. Even there, we see the blue line here is the interest rate on outstanding mortgages, and it's moving quite slowly with the policy rate. So even with like our big spikes in refinancing that happened during COVID, so it's not on this graph, for example, we do see that the outstanding rate is changing slowly. I will show you at the very end that we did estimate a version of the attention model that we're going to estimate on US data. And so we do have an interesting contrast there for you.
I'll say that the US has fixed rates. So the policy rate isn't what drives refis. It's actually what the long, you look kind of a 10-year bond. And so those have deviated a fair bit. So the slope of the yield curve has moved a lot. So,
Yeah, that
it
said,
definitely is downward sloping,
Yeah.
but the industry was effectively capacity constrained.
right.
So for
No,
2 years more, including for COVID, there was more demand than there was the ability to actually execute on it.
Totally agree. That said, you can see this strong correlation with the policy rate on new mortgages because of the correlation between, like, say, the 10-year and the policy rate, that you do get something that looks fairly correlated, but all good points. Okay, so we're thinking about COVID effects here. Maybe the worry is that people have a higher desire to save money. They have more attention that's spare. And so, first of all the more reason to do an RCT and to be able to have the control group that also gets the treatment letter, that also has the incentive to want to refinance, that also might be at home. We don't see a lot of heterogeneity on the COVID forbearance group. So the group that might, as evidence to have the most acute need of more financial flexibility, they're not more likely to take advantage of the reminder. And we don't see a strong trend in Ireland in external refinancing in 2020 versus 2019. That would be different than the United States, for example. And then the last thing we did is we have a coarse measure of the sector that you work in. And so we can see that you're likely to work from home, you're likely to still be working in person, you're likely to be laid off, and we don't see treatment effects varying across those three groups. So that's kind of our evidence that we are optimistic that this is not purely some kind of COVID effect. Okay, so kind of concluding on the treatment effects, the best kind of combination of treatment and reminder had an 80% effect on refinancing. The denominator is small, so that's a 7 percentage point effect on refinancing. The average redesign of just the disclosure alone had just a 2 percentage point effects. We don't see any effect on external refinancing. That might hint that some of the barriers to the failure to refinance are, in fact, that people find it much easier to do an internal refi than an external refi, and speaks to the importance of that opportunity. We looked at treatment effect heterogeneity. We're somewhat underpowered to do that. We're working on causal forest methods right now to work on that. But I will say that we have fairly precise zeros on the treatment effect heterogeneity of the reminders. So the reminders don't seem to be more or less effective for any of the groups that we looked at, whether they have a high balance or they're old or they live in Dublin or they don't, or they're, they've held onto their mortgage for a long time. So reminders are getting through to borrowers. To Chris's point, it's not totally clear whether this is the fact that you had forgotten something and needed to be reminded of it, or it's just the design of this particular communication was the most effective. It's certainly simpler. It's unexpected. So if you're attuned to getting the other disclosures, or you're attuned to getting mailings about this, then you might be in a state of kind of ignoring it. You might throw it out, but you might also put it on your desk on a pile of papers, and it slowly ends up being buried below other things to take care of. And the reminder letter reminds you that you had always intended to do this, and helps you kind of marshal your efforts to be able to do this. Okay, so now we want to think about what effect this has on the likelihood that someone's paying attention, and the relative effectiveness of that with changing interest rates. So to do that, I'm going to introduce an inattention model of refinancing. And the first thing I'm going to do is to have a model of how people would refinance if they were paying perfect attention. So there's some incentive to refinance. There's a few different ways that you could calculate that. I'll explain one of them in a second. And beta is going to be how sensitive you are to your monetary incentive to refinance. And then epsilon is any unobserved heterogeneity that the household has in terms of their private costs or benefits of paying of refinancing. So what's the right measure of your refinancing incentive? For most of what I'm going to show you, and most of what we do in the paper, we take the closed form solution of the Agrawal-Driscoll-Leibson optimal mortgage refinancing exercise. There's a bunch of simplifying assumptions that go into this, but it basically spits out for a US style fixed rate mortgage, the threshold that you would have to be that you'd have to be able to save for you to refinance. So if that spits out O equals 100 basis points, that means that until rates have fallen and you could save at least 100 basis points, then you wouldn't want to refinance. You would have a negative or a zero incentive to refinance. But once you've crossed 100 basis points, then your option is in the money to refinance, and you have a positive incentive to do it. So this actually seems to work pretty well. I'll show you a graph of what this looks like, a density of what this looks like in Ireland. But one problem here is that technically this is for someone that's refinancing from a 30-year fixed to a 30-year fixed. And you're not doing that in Ireland. You're refinancing to something that looks more like a US adjustable rate mortgage. De facto, people treat these as fixed mortgages in the sense that the average duration of a mortgage in the US is like, 9-10 years, even for a fixed rate mortgage. It's similar in Ireland. And so people are kind of treating it like a fixed rate mortgage. But one thing we can do is just omit O entirely and run this incentive model with just the gap, the interest rate gap, the coupon gap between the old and the new mortgage. Okay, so if we can run this as a logit, if we assume that the shocks that we don't see, the unobserved heterogeneity is type 1 extreme value, and we get this nice formula for what it would look like for someone to refinance, beta is going to estimate their incentive, their sensitivity to the incentive to refinance. Okay, so here's the distribution of the ADL incentive to refinance in our data. You see that most people are around 100 basis points. That's consistent with what I was showing you, that they're at 4.2. They could refinance to 2.9, and their refinancing option is in the money substantially. What I plotted in red, this is smoothed because we've got not a lot of data in some of these bins, so I've done some kernel smoothing to it, but this is the gradient of refinancing with respect to the incentive. So this model seems to capture this fairly well in the sense that you do not see very many people refinancing, that the model would predict, the ADL model would predict they have a negative incentive to refinance. And then you see more and more people refinancing the higher this incentive gets. That said, the level of this is still quite small, right? And that is pointing to the fact that, 8.9% of people are in the control group are refinancing, even though they have this substantial incentive to do so. Okay, good. I think I had jumped. Jumping around. Okay. Now we want to build in the possibility that someone is inattentive. And here we go. We're going to allow people to have an attention shock as well. And attentive households refinance, like I said, when they have this reason to do so. But inattentive households are going to refinance if they have the kind of net benefits of paying attention to be positive. So every household has its own unobserved inattention shock ADA that we don't see. This might capture like whether you come home from working your second job and immediately need to take care of kids. It might capture private information you have about the likelihood that you're going to be moving abroad, and so refinancing doesn't really make sense to you. Any reason we can't see for why you might not pay attention to refinancing opportunities, and therefore might not be sensitive to refinancing opportunities at all. Delta 0 is going to capture the kind of the baseline probability that you are inattentive. And then we're going to have two treatment effects on here. So the idea is that Delta 1 and Delta 2 are going to capture the differential attention for people that are randomly assigned to get the enhanced disclosure or the reminder itself. So that means that you put this in again with a logit assumption on the ADAs, we have a nice mixture model that's developing. We've got the probability that a household is not paying attention is going to be the logit function of this index. So who's going to refinance? You're going to refinance if you're paying attention. So that's going to be 1 minus the probability you're not paying attention, times the probability that it makes sense to refinance, that if you were attentive, conditional on being attentive, the benefits would outweigh the costs for you to refinance. So Delta 1 and Delta 2, they're giving us treatment effects in this mixture model of on attention. And this is something that ideally you could elicit kind of with a survey. I did that in the UK. You could see how many people didn't even remember that they had gotten a letter. We didn't have the opportunity to do a survey here, but the model is going to imply based on this functional form and then this experimental variation on the attention term, what the effects of the experiment were on paying attention. Delta 0 is going to be harder to interpret as purely attention because anything else that goes into you not being sensitive to the refinancing opportunity, like I was mentioning, it could affect Delta 0, but we think Delta 1 and Delta 2 are not likely to be affecting your constraints. They're not likely to be affecting your private information. And so we've got this nice balance there. Okay, so I showed you this refinancing incentive, and then we're going to put all of that together in a mixture model with maximum likelihood. We have all the people that refinanced. They only refinanced if they were attentive. That's 1 minus the probability they were inattentive times the probability that they wanted to refinance. And then the people that didn't refinance, they were either inattentive or they were attentive, but it didn't make sense for them to do it because it wasn't advantageous for them to do it. And often what happens in these sorts of models is if you don't have any of these attention firms and you put in some fixed cost, people just behave like the fixed cost of refinancing is astronomical. And that's going to be no exception here. So let me show you some of these results. And then I'm going to skip to the next slide where I can interpret the magnitudes a little bit more in a more straightforward way. So this is our estimate of beta when we're not allowing for there to be any private fixed cost of refinancing or any attention term. And e to the beta is what's multiplying the incentive. So this is essentially 0. It's 0 to several decimal places. This is saying that the model can't see anyone being sensitive if it doesn't allow for people to have a high threshold for being willing to refinance. Think of this as like the hassle cost, the psychological cost, and assumes that everyone's paying attention. Okay, if I go to a more traditional model where I allow for there to be a fixed cost of refinancing, now the coefficient on the incentive starts to look much larger. So it's going to be a small positive number instead of 0. But now the fixed cost is really high. So this is also in the model exponentiated. I didn't show you that math. So this is implying like something like a $300,000 fixed cost of refinancing. Remember, balances are $85,000. So if you don't have this attention term, it just looks like people's private cost of refinancing is astronomical. You put in attention and all of a sudden this looks much more reasonable. Now this looks like they have a $300 hassle cost of refinancing. And when you allow for there to be reminder effects, this jumps up to like a 3,000 euro effect on refinancing. And then, by the way, you start to get the incentive to come much more in line where people are starting to pay attention to the incentive. Okay, so let me move forward and tell you what these marginal effects are and interpret them in magnitudes that make sense. So the magnitude on beta, that implies that if you have a 10 basis point decrease in rates, you're going to see an increase in refinancing of 50 basis points. So it's suggesting that people are responsive to rates. The fixed cost estimates, if you don't allow for attention, like I said, astronomically high. They're still high when you allow for inattention. If I think about the actual time it would take, that's consistent with inattention. It's also consistent with pessimistic beliefs around how long this is going to take and a strong disutility of financial paperwork. If I look at delta 0, this is saying that at baseline, 76% of people are not paying attention. So that's how the model rationalizes the sensitivity to refinancing seen in the Irish data. It implies that most people are not paying attention. However, the treatment effect and the reminder effect reduce the inattention probability by 16 basis points, so that, instead of 24% of people paying attention, it's 40% of people paying attention. So back of the envelope, this means that if you took the average gain that people could save by refinancing, and you take an MPC out of interest savings, so we have estimates in the US that find the MPC here is like 0.75. The Bank of England uses 0.5, so that's more conservative. So we're going to use that. It's saying that like you do consume a high fraction of your interest savings. That would say that the average refinancing household is able to increase their consumption by 600 euros. You average that across the entire experiment, because only 7% increase in refinancing. You get a 42 euro increase per household in consumption. As a very strong multiplier when you think of the cost conservatively of sending out the reminders is going to be something like 1 euro. That's like printing and postage and all of that. So it seems like an interesting tool that competition authorities could use, consumer protection authorities could use, and policymakers that were trying to do monetary stimulus but were constrained for some reason could think about using as well. To show you what kind of effects this has on refinancing compared to rates, what I'm going to do is I'm going to hold, using my model estimates, I'm going to hold attention fixed. I'm going to ask, what would happen if you moved the incentive to refinance from 100 basis points to 200 basis points? And the sensitivity that I get to refinancing and the inattention that I get is going to tell me what percentage impact I would expect to see on refinancing. I know what that effect is for reminders. I can get that from the reduced form effects. And the model is going to allow me to estimate that for Ireland. Now, the model comes from Anderson et al. They estimated this in Denmark. They didn't have any experimental variation. They didn't have those experimental treatment effects, but I can get their delta zero and I can get their beta. And so I can show you what this would imply this change in refinancing would be in Denmark if rates fell by 100 basis points and attention didn't change. And then I can do the same thing in the United States. Again, I can't do the experimental treatment effects, but I can also estimate delta naught. I can estimate beta using CRISM data in the United States, basically LPS data on prepayment, and see what that would be. Okay, so this is the paper in a nutshell in this graph. The refinancing effect of the treatment without a reminder is 1.8 percentage points. If you do with a reminder, the average reminder, 5.4 percentage points. The best reminder treatment combination was 6.8 percentage points. The model says that if you lowered rates by 100 basis points and attention didn't change, I'll return to that in a second, ceteris paribus, then you would only get a 1.2 percentage point increase in refinancing in Ireland. And I have confidence intervals on my coefficients, so I can use the delta method to get confidence intervals on this prediction. In the US, very similar results, actually. I get different estimates on the probability that you're inattentive and different estimates on the fixed costs. But when I put all of these together, I get similar effects on what would happen if you lowered rates by 100 basis points in the US, based on people's historical behavior in the US. I should say I deliberately picked a quiet period when rates weren't changing. So this is not estimated on like COVID data where there was a huge refinancing boom. This is estimated on a 4-month stretch of 2019 when rates were low, but fairly flat, so that I could compare it to the Ireland setting. And then I don't have confidence intervals for the Campbell, for the Anderson et al. Estimates for Denmark, but I get similar estimates there. So 2 points to make. This is ceteris paribus. You would think that if I lowered rates by 100 basis points, that attention would change. Certainly there would be a big marketing surge in the United States, and I would hear ads on the radio that mortgage rates had fallen dramatically. So this is saying, what would happen if you lowered rates by 100 basis points, but you didn't change attention. The second, though, is that lowering rates, mortgage retail rates by 100 basis points takes a lot of monetary work. There's limited pass-through, especially in Ireland. And so this would be a fairly extreme thing to happen. And even in this extreme world, given prevailing inattention, you wouldn't see a lot of refinancing. Stein, is your hand still up from before, or is it?
I have a new question.
Great, jump in.
So what about so these are super interesting. Sort of one question that comes to mind is, what about the capacity constraints on refinancing, right? So we sort of know that when there's refi booms, because of personnel issues and so forth, it's hard to scale up. Yeah. And then that sort of gets translated into much higher profitability at the and then sort of taking that some of that margin away from the consumer.
Yeah. So, I mean, ultimately, that would be a reason why. So this is saying, what if you could lower rates by 100 basis point, retail rates? And your point is that, like, even if given capacity constraints, the amount of monetary stimulus you need to do to get rates for that people are actually realizing by refinancing would be astronomical, right? It would just be even larger. And then there would be interesting things that would happen, like we saw that you and Chris are alluding to during COVID, where credit access is quite uneven and it's hard to get people to take your phone call unless you're moving a lot of money to their bank and things like that. I would just say that those are all headwinds for refinancing in general. Are those also headwinds if you did communication like this at scale? They could well be. Certainly the scale that we're looking at in Ireland for an internal refinancing, it's bureaucratically quite simple. They're not re-underwriting all the loans. And so that might be an interesting piece of the puzzle.
Yeah, you could sort of imagine sort of timing your intervention carefully, your attention intervention carefully. For example, sort of right after a big refinancing wave, now there's all these loan officers with some spare capacity, but there's still all these people that haven't refinanced that could still profitably do so. And now there's available capacity, something like that.
A no borrower left behind act.
Right.
Yeah, I like that.
So you're more than welcome to go over. Oh, you're wrapping up. Great. 1 minute left.
Yeah, thank you. So let me mention a couple caveats here that I think are relevant. So first of all, as was highlighted by Michael at the top, communication certainly should depend on the trust in the disclosure, and the Johnson et al. RFS paper that looks at HARP kind of failures to take advantage of that seemed that a big part of it was distrust in like what's the catch here, right? So one thing that might help, in some countries it might hurt, would just send the letters from the government with a letterhead from somebody that is maybe perceived to have your interest more at heart. And so that's an interesting thing for policymakers to think about, adding that tool, that arrow to their quiver. And it would be very interesting to see experiments along those lines in other settings. Of course, in general equilibrium, if you have more attentive refinancing, you could see higher rates at origination. Because lenders are essentially not going to be able to bank on having you inattentively paying at a higher rate for much longer, and so they than they used to be able to, and so they might raise rates in equilibrium. There's an interesting Berger et al. Paper, and the paper that Gaston presented a month or two ago does a nice treatment of this with their model in Chile. On the other hand, you could also imagine competition hardening from this happening, where you have basically the variable rate has to start to be more competitive, and because people are refinancing, it starts to discipline the variable rate, and that could, in general equilibrium, kind of take away the need for reminders because the market structure changes so that people are being more competitive. Reminders might be more or less effective over time as you do this repeatedly. There's dynamic selection. They also might lose their salience, or you start to trust them more, and you might learn from peer effects. They might be reinforced. Like we've talked about, they're probably much more effective when rates have fallen recently, so more people are in the money. But in every economy that I've looked at, there's still a lot of people at any given time that could benefit a lot from refinancing. So wrapping up, it seems that inattention to optimization is just ubiquitous. We have something that we think actually makes a difference on the attention side. This kind of communication, it's a significant source, attention is, of refinancing inertia. That's important for monetary policy. It's important for consumer protection. It's important for competition. We have a remedy that we think helps with this last mile of monetary policy. It's complementary to standard monetary policy, but quite possibly more effective given some of the other frictions that we've talked about. Thanks very much.
Right. Thank you, Christopher. Just another question is like, from your result, whether do you know who are these inattentive kind of borrower who, despite sending the reminder, do you find any heterogeneity in the response?
Yeah, ultimately, we don't have enough power to sort of run the maximum likelihood mixture model with heterogeneity in attention in it, which would be really interesting. Campbell et al., when they ran this model, they had like an order of magnitude more observations, and they found that it was quite intuitive who was inattentive. So there's often a U-shaped relationship where the young and the old are making suboptimal financial decisions and are more inattentive. So that was one thing that was certainly there. So we don't do a lot on that in the paper, but there is literature that looks at like what are the demographics that are the least likely to refinance. For us, it was really interesting that we didn't see a lot of treatment effect heterogeneity, that it wasn't like you were hitting sophisticated people, and this ended up being a fairly regressive policy intervention because only the kind of people that didn't need it were the people that were responding. It seemed to be fairly uniform in its effectiveness.
Right, thanks. Any other question from the audience? I think it's a very interesting, David.
Yes, thank you. Thanks so much for the presentation, Chris, and great to see you.
Yeah, good to see you too, or hear you.
Yeah, so yeah, I don't know, for some reason my camera isn't working or something. But anyway, I was thinking about a competing risk model. So one of the benefits of refinance is like you lower default. Maybe it's not so important when rates are going down as opposed to going up, but now that rates are starting to go up, maybe the competing risk is a kind of thing to think about. Is that something to, I mean, given that it's a plus of the model, besides the savings that you're finding, is that something to think about?
You know, this was salient to the bank that we partnered with. It was salient to them that if they had people on lower rates, then they would have insulated default risk on when rates started to rise, right? They would be protected from that rate increase. My prior was that the bank would care more about the lost interest income than they would about the decrease in the default rate from that. But I have a colleague, Emil Werner, who has a paper that looks at what they call the debt Laffer curve. And they find that there are ranges where lowering interest rates are a net win for everyone because the default rates fall by so much. And so I think that's an interesting thing to get onto there.
Yeah, great.
Right. I think we're coming to the end of the presentation. I would like to again thanks Chris for the presentation. Also thanks everyone for the comments, and I'll leave it to David to introduce the next session.
Yep, this is going to be a little unusual. We're going to have back-to-back seminars. So next Wednesday, Mariana Kudliak from the San Francisco Fed will present house price responses to monetary policy surprises, evidence from the U.S. listings data. Should be a great paper, just like Chris's. So I hope to see you all there. And thank you all very much.
Right. Thank you very much.